Welcome to your Essential Business Briefing. I'm Kate Moody. Today's show is all about the UK economy. Coming up, unemployment is down, but so is GDP growth. Just how strong is the world's sixth largest economy? The not-so-invisible elephant on the campaign trail? How is Brexit affecting business investment and consumer confidence? And with general elections looming, what are the major parties proposing to boost economic growth and improve the standard of living? British voters are heading towards their third election in 4 years, hoping to break the Brexit deadlock in Parliament. Uncertainty over the UK's departure from the European Union has already hampered investment. The economy has been sluggish for most of the year, despite a robust labour market and healthy consumer spending. So what exactly is the state of the British economy? Yuka Royer reports.
As the end-of-year shopping season arrives, the UK economy remains in the doldrums. Retail sales dropped slightly in October from the previous month, adding to already mounting uncertainties. Strong consumer spending, boosted by a robust labour market, had been shoring up the British economy in the wake of the 2016 Brexit referendum, the current volume being about 10% higher than that year. Despite the market turmoil the vote unleashed, the unemployment rate continued its decline, which started in late 2011. Until it steadied at just below 4% last year. Inflation, on the other hand, rose close to 3% by late 2017, partly due to a weakening pound. It has been in decline since then, coming down to 1.5% in October. A decline also in Britain's economic output, both in manufacturing and services sectors. As the prospect of a no-deal Brexit continued to loom, businesses started taking flight to continental Europe.
Brexit shows extremely clearly how uncertainty over the direction of policies can induce a serious lack of investment, and that has long-lasting effect.
Official figures show Britain managed to dodge a recession defined by 2 consecutive quarters of negative growth. But the OECD's long-term forecast remains pessimistic. It expects GDP growth to hit the lowest level in recent years next year, before bouncing back in 2021.
Well, to help understand what all those numbers mean, let's turn to Simon French, Chief Economist at Panmure Gordon in London. Simon, thanks for being with us. When you look at the raft of data painting a picture of the British economy, what stick out for you as the most worrying and encouraging signs?
Well, let's start with the worrying signs. The business investment data for the last 3 years has suggested that the headwind of Brexit discussions with the European Union has really put a dampener on the UK economy and its underlying growth rate. You also worry about export orders. We've had a big devaluation in sterling over the last 2-3 years. That should have boosted export orders. That hasn't really come through. On the flip side, however, we continue to see very decent jobs growth. Unemployment is at pretty much a 40-year low in the UK economy. Wages are growing by more than 3.5% year on year. So actually, consumers, households, are feeling quite well off. By contrast, it's the businesses who are feeling much more cautious about what's to come.
How much of that slowdown can be linked to Brexit, and how much to the overall slowdown that we've seen in the global economy?
Yeah, it's a really good question, because a lot just gets lumped to the door of Brexit. Everything is seen within that lens, but that is not correct. If you look at the overall growth profile of the UK economy in recent years, it has largely followed the accelerating pattern of the global economy in 2017 and early 2018, and then the subsequent slowdown. You can see some discernible Brexit effects, as I said, on business investment, but if you look at the manufacturing sector, for example, that's been highly sensitive to the global trade war, the slowdown in global trade volumes. So I certainly think any analysis of the UK economy that starts and ends with Brexit is fundamentally flawed.
Now, the services sector is one of the areas that had been helping prop up the British economy. Data suggests that it has now turned downwards. And this, of course, is a sector that covers everything from retail to hospitality, education and banking. Could this be a death knell for the British economy? Does it make a recession all but unavoidable?
No, I don't think it does make a recession all but unavoidable. The services economy highly sensitive to retail sales. Retailing, although the companies within the retail sector are struggling, consumers show no sign at all of putting their wallets back in their pockets. On the contrary, actually retail sales have been relatively strong off the back of that record employment, decent wage growth. So I don't anticipate a recession, 2 successive quarters of negative growth. On the flip, or what you do, however, expect is very modest growth while the Brexit discussions ramp up a gear in 2020.
How much longer can the economy depend, though, on that kind of strong household spending? We've seen household savings dropping recently. Is that perhaps a more serious long-term problem?
Look, the very low savings ratio is a structural problem for the UK economy. The households have responded to a combination of those low unemployment rates, but also very low interest rates, which is a bit of a global phenomenon. They've driven their savings ratio down to almost just 5% of take-home pay. Now, that is low and that is worrying. I think there is another part of the economic story that we haven't covered, which is very relevant, which is public spending, government spending. There is an expectation whoever wins the election in December, the general election here in the UK, we will have significantly greater amount of public spending, fiscal tax cuts and public spending, which will feed growth next year and beyond. And that has to lean against any potential weakness in households who may feel they've overstretched themselves.
Do you think that businesses should still be preparing for a no-deal Brexit?
It's a great question. Look, there is a scenario where if the withdrawal agreement that was negotiated between the EU27 and the UK government, if that passes the UK Parliament in January and the UK leaves on January the 31st, which is our base assumption, then there is 11 months from that point to the end of December 2020 to try and negotiate the new relationship between the EU27 and the UK. If those discussions go badly, then there is certainly a commitment from the Conservative Party, the current governing party here in the UK, to leave that transition period, that 11-month standstill period, leave it on the 31st of December 2020, and that effectively is a no deal. And that introduces all the frictions that have worried businesses over the last 2 to 3 years. So yes, it is a real prospect, but of course discussions have taken a fairly volatile path over the last 2 to 3 years, so it would be a very brave investor who takes a view on where they will evolve over the course of 2020.
Simon, stay with us for a moment because I'd like to take a closer look at the Conservative and Labour Party manifestos. Take a listen to Boris Johnson and Jeremy Corbyn on the campaign trail recently.
Investments in science, the doubling of our science and research budgets, fantastic investments in infrastructure, tackling our immigration, and we can do it all without raising income tax or VAT or national insurance contributions. We're going to cut national insurance contributions and a tax cut for 31 million people across this country.
What we've put forward is a sensible, costed plan of how we can improve public services and life opportunities in this country and develop an economy for the future at the same time as meeting our net zero requirements for environmental sustainability.
So those are just a couple snippets of what we've been hearing over the past few weeks. Let's start, if we will, with the incumbent Conservatives. Are Boris Johnson's promises to reduce the tax burden feasible? They're
feasible. Whether they are realistic is a very different question. Look, the tax take in the UK is at a multi-decade high, but part of that is the result of a phenomenon that's we're seeing across the world, which is an ageing population requiring more in pension payments, requiring more in health care and social care requirements. So we're having to take more in tax in order to fund those public services. Now, at the same time, the Conservatives are trying to say, look, we will honour all those commitments and we'll cut taxes. Now, if that happens, then the reality is the public sector borrowing is going to have to go up to fill the gap. The question mark over the Conservative manifesto is whether they can deliver that tax cut, deliver those public service commitments, and not let borrowing get out of control or have to go back on those promises later in the Parliament.
Jeremy Corbyn, meanwhile, has outlined a starkly different view, including massive increase in government spending and the possible nationalisation of energy giants and BT. After nearly a decade of Conservative rule, is this kind of change what voters want?
Well, the nationalisation agenda of Jeremy Corbyn's is something that really divides the UK public. There are a number of areas, industries where nationalisation is very popular, and actually a lot of the average electorate would actually like to see things like water services, the railways go back into public ownership, but those things won't be free. Those will come with a big upfront cost, and although the state gets back the asset, you do have question marks whether the state is the best authority to run those organisations. But the concern that I would have as an economist is much more around the scale of the ambition of this ramp up in public spending. Some quite eye-watering figures, more than £130 billion of additional spending over the course of the next few years. That's an awful lot for an economy near full employment to be able to absorb. And if it can't absorb it efficiently, it'll absorb it inefficiently. And that is, of course, what you worry about as an economist. You see efficiency reduced and the quality of that taxpayer spending significantly reduced also.
Markets have been in a state of on and off turmoil, really, over the political uncertainty and the Brexit uncertainty in the UK. Will this election finally put an end to that?
Well, there's certainly a lot of investors hoping so, because UK assets, the UK listed companies on the London Stock Exchange, are valued about 20% below comparative companies across the world. And that discount, which is quite persistent, has emerged over the last 3 years as investors have said, look, we want to see more political clarity in the UK before we put investment back into that economy. Now, if we do get clarity at the upcoming general election, I would expect some of that discount to be removed as you get rid of some of the political uncertainty that's dogged the UK economy. But I wouldn't expect that in the entirety of that 20% discount to come off, because, of course, you have that difficult stage 2 of negotiations, which, there still remains in the background, the risk of a no-deal Brexit. So business investment will boost. I think sterling would rise and equities would rise, but there will be a limit to that recovery bounce.
All right, Simon French of Panmure Gordon, thanks so much for joining us from London. And thank you for watching. Don't forget to follow France 24's coverage of the British elections. You can also get in touch on Facebook at France 24 Business, or you can tweet me at Kate A. Moody. Until next time, stay tuned to France 24.
My name is Mandakini Gehlot, and I'm the France 24 correspondent in New Delhi. I cover news from India and other countries in South Asia. Catch me on our news bulletins from the region.
Mandakini Gehlot, one of the 200 France 24 correspondents around the world.